Welcome, everybody. Thanks for coming out for our workshop on the Tax Cut and Jobs Act. We'll go through some of the particulars of that, hopefully give you a little bit of understanding of what the bill is all about, and the implementation is still evolving. If you want to come a little closer, you can see the screen better. If you're comfortable where you are, that's certainly okay, but just to let you know that. We have spent a lot of time learning about this. We'll continue to spend a lot more time learning about it because the IRS is not done writing the rules. All the forms are pretty much out. We've seen the 2018 forms, and you're going to find those considerably different. If you do a self-prepared return, you certainly will see that. When we give you your copy, you'll say, well, what happened to this and that? It's a lot different. So we'll be sharing that as we go along the way. This is the biggest reform we've had in the tax law since 1986. Those of you who have been around since that time, and I have, realized the pain and agony of losing our credit card interest deduction, our car loan interest deduction. Those things went away. They limited our medical expenses. They added the 2% limitation on miscellaneous deductions before we had to do 100% of that. Depreciation was totally turned upside down, and we thought we would never get through it. The nice thing about that is they lowered the tax rate substantially in giving us those changes. So we enjoyed that for a while. The 28% top bracket has creeped up to 39.6. So it was time for Congress to think about doing some other things. So that's kind of how we got here. There are a lot of pitfalls. There's a lot of opportunities. We will see those as we go through this. You're going to find a lot of good things and say, boy, that's really good. I appreciate that. And then you're going to find, oh, we can't deduct that anymore. So that's the give and take of getting a tax law through Congress and getting it in front of us. So planning and timing is very important. The adjusted gross and taxable income levels are very critical to some of the provisions that we're going to have. So that will be important for us to understand. And we'll have questions at the transitions. I'm going to give you a couple of opening points here, and then we're going to have Tim come up and talk about some of the individual provisions, and then Chris will come up and talk about some more business adjustments that have come about, and then I will finish it up at the last half to talk about the qualified business income deduction and all its nuances and how complex it is, which I think is unnecessarily so, but it is what it is. So we'll try to do our best in getting through that. We do have a number of people joining us online, and we welcome them as well. If you raise your hand, I won't be able to see it, so you can email your questions later. But we'll do as best we can with that. Start with a little humor. Ignore line 13A if line 12B is greater than the specific gravity of Jupiter. You're right, these tax forms have gotten too complex. Sometimes we feel that's the case. What do you mean by that? So we got such and such on this line and it's blank. Well, we did something wrong to get to the amount that got to that blank. So it's really a challenge to get through these things. And so we're going to do our best to explain what happened. So why do we have tax reform? Well, it's always a political process, but the tax code had really gotten way too complex. And I'm not sure they accomplished anything by adding 1,097 pages to the law. But we had to have some changes that have gotten really unwieldy. And there's probably a technical corrections bill that we'll get out before the end of the year to clean up some of that. So that's part of the reason. Second, it had been 31 years, as I said, since we'd had a major change. And the pin-up demand of Congress, it had been almost exactly that since the 54 code came out in the 86 Act. So they just get this pin-up demand. We got to do a bunch of stuff, so let's do it. So that's another justification. And probably the biggest motivation was political, as we wanted to have a stimulus, as was promised in the last election, presidential election, to get this done. So we got a bill through Congress. It was not as exactly promised. It had a lot of bumps and bruises along the way, but substantially it came through with the corporate tax rate reduction that was promised, and then some other changes got done along the way. Somehow they had to pay for it, as they say, but when you got $1 trillion deficit, it's not really paid for, but we have what we have. So what do we get? So here are the key points. First of all, the individual rates dropped from the 10% minimum to 39.6 maximum, down to a 10% to a 37%. Well, that doesn't sound like a big deal, but there are some other things that change to get to the amount of taxable income that goes against those percentages. The rate brackets have expanded, and some people are going to find themselves in a lower bracket than they were before. The corporate rates dropped from 35% maximum to 21%. That is a big deal, but there are some lost deductions in order to get there, so we'll see some of those things along the way. The qualified business income deduction, That's the most complicated, the most time-consuming part of our study. Anytime you read an article, it goes into some effort to explain it, make it simple, but there's just no way to make it simple. We'll try to do our best to get through that. And there's a lot of other party gifts along the way that you'll see that we haven't had before. Some credits have changed, some exemptions have gone away, and this bill is very comprehensive, so we're going to try to make that as clear as possible. And it's predominantly effective this year. There's a couple things were effective at the end of 17, particularly related to depreciation and mortgage interest. Then a couple things are not effective till next year. The biggest one there is alimony deductions. Big deal for those that are in those situations. And we'll have a little disclaimer to say this is a general session. We're going to give you the best information that we possibly can. And if you have questions, we'll be glad to answer those at each of the breaks between the speakers. But it is a general session, and we need to get with you individually if you need a customized approach to whatever your situation is. So what do we have here? Some people's taxes will go up, some will go down, and some will stay the same. What's your situation? Well, everybody's going to have a different mix to come up with that. For the most part, very few will go up, quite a few will go down, and probably 15-20% will be very similar to what they had before. Just the mix of your income and deduction, your family situation, whether you have a business or not, how much income you have there, all those different factors go into that. It's now a multi-dimensional, it has been to some degree, but it's very much a multi-dimensional approach, multi-year approach, because the individual rates are all going to revert back to the old rates into 2026. So we have to look at what is the best thing to do in this 8-year window to take advantage of these lower rates and special provisions. Most of the business provisions are permanent, however, whatever permanent means in terms of congressional law. So there's going to be planning strategies to work with. We have to learn some new languages, some new terms, have a different understanding of how we approach it, because it's not the same old thing. Some examples that we will have between the 17 and 18 provisions and going beyond that. Generally, the rates are lower. Taxable income, though, will probably be higher. Some things you used to be able to deduct, you can't. Tax rates are lower, so higher tax or higher taxable income, lower rates, you're going to have a better situation. We'll learn the definition of QBI, QBID, and SSTB, all related to the new 20% deduction for pass-through entities. Deduction stacking, that's a new term that's going around. I've always called it bunching, but it's even more important now because we have a higher standard deduction. We're going to find ways to accomplish things by bunching our deductions every other year to take advantage of that provision. And then there's a change in the value of a deduction. Because your tax rate may be different, the value of a deduction may be different. So you may think differently about how you approach transactions, whether you want deductions or not, whether they are beneficial to you. So how does this affect my personal return? This is where Tim's going to take over and share with you on that.
Great. Thank you, Mark. Thank you, Mark. I appreciate that. All right, so as Mark mentioned before, we're going to break this into a couple of different spots. I'll cover the individuals, then we'll have Chris do some business, and then Mark's going to come back and really hit you with the meat and potatoes of what we're dealing with here with the QBI. All right, so first off on the 1040 side, so let's take a look just at the differences in our personal deductions. So I've got standard deduction versus itemized deductions, but let's look at this in 2018. Your standard deductions are now up quite a bit, nearly double. For a single filer, you're at $12,000. For a head of household, you're up to $18,000, which is great. And then for those who are married, there's the $24,000. Again, no marriage penalty for there. Really interesting comes in on the itemized deductions, because what we give, we have to take away. On the itemized deductions, there's going to be no Pease phase outs. Those were where Senator Pease, when your exemptions and other items became so great, you got a little bit of a haircut as your income went up. So those Pease phase outs are now gone. State taxes are being limited, so they're being capped at $10,000. Got to be careful of those going forward, especially if you're have multiple properties or maybe you're in a high tax state. Mortgage interest had some changes there in regards to large jumbo loans, or if you're going to go refinancing, for example, line of credits, home equity mortgages going forward. Be really careful of those. Some of those may not be deductible going forward. You want to be careful if you ever decide to refinance, because if you refinance, you could mess up the grandfathering provision there as well. So talk to your tax advisor before you go out and mess with the home mortgages. Charitable deductions, we're now at 60% of AGI, so that's a little bit of a benefit for us. Casualty losses are being redefined. To simplify it, it's basically, it needs to be a presidentially declared disaster at this point in order for it to qualify. And the biggie, no more 2% itemized deductions. A little further in the slide deck, I'll talk about what those are. But think about it, that's a really big deal. If you've got a taxpayer or somebody with a lot of unreimbursed business expenses, those are no longer deductible. Fees for legal and tax advice are no longer deductible. All of those 2% have gone away, so we need to start planning around those. Now let's switch over to the exemptions. Back in 2017, you did get a personal exemption. You got about $4,000 for an individual, and you got a $1,000 child credit. We've kind of flipped that all upside down again. Because the standard deductions are now higher, you have a little less need. So again, what they gave you, they had to take away. So Congress has done away with the exemptions. It's now 0. But they did offer you a little bit of a child credit. So if you're 17 and under, again, they did change who qualifies under the child's. So $2,000 for the exemption. They did give you a little extra. So for example, if you had another dependent who was older than 17 but was still in your household, they did give you a little extra bump so that you don't totally lose out on those. And that's a $5,000 dependent credit. The income phase-outs are at a much higher rate as well, nearly double. So if you're looking at single or head of household, you begin to phase out between $200,000 and $240,000. And if you're married, you're in the $400 to $440 range. So let's kind of take a look at some of the other issues. And again, like I mentioned, the itemized deductions are going away. This is a big deal. Look at the long list. You've got moving and job hunting expenses. Those are going away. Unreimbursed business, employee expenses, investment advisory fees, the home office deduction. That's a very big deal, especially if you're a salesman, you're on the road, or maybe your employer isn't reimbursing you for a lot of those business expenses. Things like union dues, again, professional licensing, hobby losses, gambling losses, all of these things are no longer deductible because they've done away with that 2% itemized deduction. A couple of changes regarding the NOLs. This is a big deal as well. You're now limited to NOLs up to the first $250,000. That's all you can deduct over on the personal side. NOLs are no longer being carried back. Again, the exception on the screen there is the farming NOLs. Those can still be carried back to 2 years. None of the other NOLs are allowed to be carried back, but it used to be you were limited to carrying forward for 20 years. Now you can actually carry those forward indefinitely, with a couple of caveats, of course. Going back to any carry forward, you're only allowed to take up 80%. So I've got an NOL in this year. I've used the NOL. I've taken my $250,000 and I'm carrying some forward. I'm only allowed to offset up to 80% of my income in the future. So that's what they mean by the 80% offset. I mentioned the public charities. Deductions are now 60% of the AGI versus the 50. The kiddie tax is another interesting twist here. It used to be that you had a complex calculation to where if you had a qualifying child, 17 or below, I believe, and you made more than $2,100 of unearned investment type income, they would actually make you tax that portion of the income at the parent's rate. So a lot of times you'd have to figure out what's the parent's rate. Maybe I'm not doing the parent's return. Maybe you are. Maybe the kid's filing somewhere else. So it's really complicated trying to coordinate those two tax rates. They've simplified that a little bit and said, okay, instead of using the parent's highest rate, we're now going to use the trust rate. Yeah, that simplified it, but it also made it more expensive because your trust hit those higher brackets much sooner than you and I as individual taxpayers would. So another little catch you there. Over on the Roth IRA side, everybody has to be careful in 2018 because there's no longer the recharacterizations. Recharacterizations were when you take a traditional, you try to bump it into a Roth and then you try to bounce it back and forth. Can't do the flip-flopping anymore. Another big tip, I think most of the divorce attorneys are on top of this, is the alimony. It's no longer deductible alimony to the payer in 2018. Starting in 2019, no longer going to be taxable to the recipient. And all of these, most of these need to be settled up by the end of the year. That's why all the divorce attorneys are cranking, because after 2018 is when these provisions come into effect. If you happen to have a divorce decree that you go back to court and you have some changes to it, that could mess up the grandfathering provision. So be careful going back, trying to go back to court for something to change the decree. It could nullify the taxability of that. AMT, this could be some good news here. The thresholds have all jumped up, which is great, $191,000 for married filing joint. And if you think about a lot of the preference items that you had that caused you to go into AMT, a lot of those preference items were 2% itemized deductions. If you do away with the 2% itemized deductions, we've done away with a lot of preference items. So that basically means that less and less people will be affected by the AMT. And let's face it, I think that's a good thing. So what's going to happen to my tax bill? Out with the old, in with the new. So it's going to be a total shift of the way we think. It's going to be a little bit different going forward. We just need to continue to work through some of these issues. Most of what we're seeing now is just proposed regulations. The IRS is still trying to process what the form is going to look like, what the final rules are going to be. So there is a little bit of ambiguity here. A couple of takeaways and reminders. Just take a look at those standard deductions. All those rows, they were, again, $6,350. Now they're $12,000 for single. Head of household was $9,350. Now it's up to $18,000. And the married filing joint went from $12,700 to $24,000. Don't forget, personal exemptions are all gone. Child credits did increase from $1,000 to $2,000. Don't forget about your itemized deductions going away, especially the property taxes and 2%. So if you take a look at all of those itemized deductions and you think about the number of people who did file Schedule A itemized deductions versus didn't. So in 2017, we had more than 26% of people nationwide in all income brackets itemized. Fast forward to 2018, it's going to be less than 8% of people will actually get a better benefit by itemizing. Creates a little less work for us, but again, that's a planning opportunity. All right, I appreciate your time, and I think I'm going to turn it over to Chris.
How are y'all doing? I'm going to talk to you about the changes to the businesses for the Tax Act. There's been a couple changes related to entertainment. On the most part, entertainment deductions on the most part are gone. What that's going to do is it's going to require a lot of changes in how those get reported in your accounting software so that they get properly reported on your tax returns. We want to make sure that we're picking up what should be deducted and making sure that what isn't supposed to get deducted doesn't get picked up. There's going to be increased options for depreciation and options for expensing repairs. What that's going to do is it's going to make sure there's more deductions that are going to be available to you sooner. Pass-through entities are going to get new tax breaks that are going to simulate the C corporation rate reductions. That's going to be expanded on by Mark when he gets through his second presentation. There's going to be more flexibility in accounting methods for reporting these taxable income changes. What that's going to mean is there's higher thresholds for these methods, and there's going to be traditionally lower limitations that are going to be easier for accounting changes to be made. So first off, we're going to go into entertaining client expenses. Traditionally, you've had entertainment expenses being deducted 50%. You've got your sporting events, your concerts, anything that's deducted at a face value. So if you go to any of those events, if you've got tickets to qualified charitable events, anything that's got ball or gala at the end. 2018, no deduction for any of those entertainment events, no deduction for the the qualified charitable events. It's a complete shock to the people who used to go to the Jaguar games, Seminole games, Gator games to entertain. They can still do that. They just don't get the deduction that they used to get. So that's a problem that companies are going to have to face going forward. Is knowing that that expense is going to be a dead expense. So for the meals provided for the employees for employer convenience, essentially that means if you've got a cafeteria on site, you're providing meals for courtesy of your employees. Your employees are working late and you're giving them meals to give them an opportunity to stay in the office and work a little longer for you. Those kind of meals traditionally have been 100% deductible by the corporation as long as they were not included in the employee's gross income. So currently, the new rule as of 2018 is those meals are now 50% deductible. So it went from 100% to 50%. That is going to be until 2025, and then they'll be non-deductible. Of course, the 2025 is like when it changes for the new regime. So we'll see if and when anything changes, but we're going from a 100% deduction to now a 50% deduction there. The business meals in connection with travel were 50%. There's no change there. So if you've got employees who are traveling and they've got meals and submit receipts, those kind of meals are still 50%. There's no change there. So as long as you have employees that are providing the substantiation, you have no change to affect those kind of entertainment or meal deductions. The entertainment meals that were 50% deductible that are directly related to conduct a business. So if you take a client out for lunch to discuss business, those are still 50% deductible until 2025, as long as they're business related. So where we start to get a little bit of a gray window is when you've got situations to where you've got a little bit of both. So you've got the entertainment and you've got the food. The best example I've seen is you used to traditionally take a client to Jaguar games. You got the box, and you've got the entertainment of the client in the box, and you've got the food that's being provided. They would normally give you your invoice, and it would say, here's how much you owe. You owe $2,500 for your box, and it includes all your food. Based on the current rules, if you provide that receipt as substantiation, zero would be deductible. So what they say now is you need to get a receipt invoice from the Jaguars or whoever you're getting this deduction from and say, here's the portion that is for the ticket for the event, and then here's the portion for the food, and then what you're going to get is you're going to get no deduction for the ticket portion, and you're going to get your 50% deduction for the food portion. That is the only way you're going to get any deduction for the food, so keep that in mind. Office holiday parties and celebrations. Previous deduction was 100%. No change in that rule. So, if you have your, Thanksgiving lunch where you buy a turkey and, have all the fixings from Bono's or whoever you get provided, you can still do that, and there's no worry of getting any limitation on that. Your charitable donation in exchange for preferential seating at college sporting events. If any of you have season tickets for Florida State, you know that there are the little receipts that you get at the end of the year that say, based on your, how many seats you bought, you had to pay $500 in order to get that seat. And of that, 80% of it is a qualifying charitable deduction. Going forward and starting in 2018, that's no longer deductible. So that's something where those universities knew about that going forward, and they started to rush and get people to start making that donation before the end of this year. But know that going forward, you no longer get that charitable deduction as a benefit on your tax return. Miscellaneous itemized deductions. As Tim alluded to, your unreimbursed business expenses are no longer deductible. So your home office deduction, anything that used to be deductible on Schedule A, are no longer going to be picked up on the return. So those are kind of things that, if you are a small business owner where you've got a S corporation, Those are kind of expenses where if you're paying those expenses and we're not currently deducting them on your S corporation return, you need to make us aware of those so that we can pick them up on your return. It'll be considered a capital contribution, so it'll be, anything like mileage that you have, any home office, deduction that we could pick up, any meals or anything like that that you normally have picked up and, just forgot to pick up within the corporation. Let us know. We'll make sure to pick those kind of things up. So other things that have affected businesses are things like accounting methods, increases to limitations, say for cash basis qualification, completed contract methods. Used to be those things used to be limited at $5 million for the threshold where you couldn't go above $5 million. Now they're up to $25 million. So there's a higher amount of clientele who can get into there regardless of industry. So there's more entities that can qualify for those various methods that can get in there. AMT for C corporations is gone. Obviously, nobody likes to pay the AMT, so that's a good thing. The UNICAP, Section 263A. UNICAP is uniform capitalization. That is where you include in inventory or capitalize certain direct costs or allocable portion of indirect costs that are related to the real or tangible property produced by the taxpayer or on property that is held for resale. So what happens there is, either for UNICAP or for cash basis and completed contract, those are both considered changes in accounting method. So if you're going to make the change for either one of those, you're going to have to file the form 3115 for change in accounting method. And when you do that, you're going to either pick up the income ratably over 4 years, or you're going to take your losses in the full year in the first year. So that's the way that you would pick up that new change. The other one is the tangible property, where you're allowed up to $2,500 that can still be expensed under the election. The one thing I'll say about that is you have to be very careful because, and the county property appraisers are really picking up on this, you have to make sure you're still picking that up on your tangible returns, because a lot of people are saying that $2,500, I'm just going to deduct it on my return, and they forget that they need to pick it up on their tangible return. So, make sure that you're still, picking that up on both your tax return as a deduction and on your tangible return as property that you're reporting. Your depreciation, there's a few changes that we'll go over. Automobiles that are less than 6,000, which have traditionally very wrongly been called luxury autos, which most, small hatchback kind of cars are luxury autos under that definition. The depreciation changes have increased the amount that you're able to take in the first, second 3 years. So as you can see, you can get a total of $47,000 of a deduction in the first 5 years of that vehicle, which usually the limits are much lower. Using bonus depreciation, you're able to get an additional $8,000 in that first year. So in total, you're able to get an additional $18,000 in that first year, whereas traditionally in prior years, you were only able to get $11,160 in the first year. So a little bit more in that range. Other depreciation, after September 27th of 2017, which is right around when the bill was passed, 100% bonus depreciation through 12/31/23. Again, we're coming up with very fun dates here. That also includes large trucks. So if somebody buys a F-350, they can write 100% of that truck off. Section 179 was increased to $1 million per year with a phase out above $2.5 million. So the key things to keep in mind with that is that bonus is something you have to elect out of. 179 is something you have to elect in. Bonus is not subject to your taxable income limitations. Section 179 is subject to taxable income limitations. So, there's a give and a take here. Make sure that you're maximizing which one we're going to take. And then obviously, you also have some other additional things that didn't previously qualify for maximization, which include the qualified improvement property. That's all I had. So does anybody have any questions?
Couple follow-up comments about some things we talked about before. When we're talking about the sporting event tickets, that you can no longer deduct the value of that entertainment, I suspect we're going to see new agreements on some of those things with the teams where they will sell you advertising, they'll sell you a banner, and then you just happen to get a cheap ticket as well. I'm sure there'll be some deals along those lines. And then when you have charity situations, you'll probably be able to make the charitable contribution outright, not tied to anything, because on the receipt, you can't have any tangible benefit other than intangible, religious, or charitable, whatever, the things that are on the receipt. You'll probably see a separation of that where you'll be able to give contributions and then you'll get the benefit of being in a pool to buy a cheaper ticket. So creative things will come along like that. When you're faced with some of those situations too, see if you've got an opportunity to do an advertising or sponsorship arrangement. So if you're going to put an ad in a school newspaper or something like that, you may want to treat that as advertising as opposed to contribution, because we recognize that those are not usually a good return on investment in those contributions because it's not your audience necessarily. But it's an opportunity to deduct it as advertising, and that would be making it a business deduction. We briefly mentioned about documentation with expenses, particularly your automobile and entertainment and those type of things, to be able to document that. That's going to become a very big deal. The IRS is going more and more after documentation for those kind of transactions. So we're going to have trouble taking the 80% of the car as an automatic deduction. We're going to have some mileage records of that. And there's a lot of good apps that have come out now, MileIQ and Expensify and things like that. We're beginning to get things tied to a GPS. So basically when you get in your car or truck, you flip it on, and then when you get to the other place, you flip it off, and it keeps off of all of those things that all the mileage that you've got, and then all you have to do is say where you went. So it's no longer the little paper book that you sit on the visor. Those are going to help us a lot with our documentation. The stacking and bunching that we mentioned early on, because we have such a high standard deduction now, there's an opportunity to push deductions into every other year. So recognizing we have a $10,000 cap on the taxes for state and local taxes, if you're going to be under that limit, you may want to be able to push those into every other year, push your contributions into every other year. So odd years, you have a lot of deductions and itemize, and then in slower years, the off years, even years, you would take the standard deduction. So you can boost your deduction one year and take the standard the next, and thereby get more benefit out of those by stacking them together. So that's an interesting thing. And then on the depreciation, if you think about it, you've got a $2,500 threshold for the deduction of miscellaneous things like computers and desks and chairs and chainsaws and all of that. That's a pretty good opportunity. But you do have to still recognize that for tangible tax for the county. So we've got to have a dual set of books, so to speak, on those assets to keep up with, which is kind of an aggravation. But it is what it is. But with that deduction and the fact that you can expense things under Section 179 up to $1 million, and you've got the bonus depreciation for anything that's beyond that, almost all tangible property will be an expensed item, one way or the other. So that gives us a great bonus on depreciation. But you have to manage your income, because if you buy equipment all in 1 year, you'll eliminate your taxable income perhaps. The next year you won't have any deduction. So you have to kind of plan the timing of these deductions along the way. The bonus is done by class. I think that was mentioned, but that's done by class. What that means, if all your trucks will have to be on bonus depreciation, or they will all be depreciated, or you can do 179 an individual. So you can pick and choose on 179 by asset, but bonus has to be by class. You either are in or out. Bonus is done by default. You have to elect out, as Chris mentioned, but 179 is electing in asset by asset. And then the extra items for the qualified investment improvement property, the roofing, that's always been a controversy. I put a new roof on. Do I deduct it as an expense repair, or is it capitalized and we have to amortize it? That's always an aggravation. It's not a problem now. A roof is automatically an expense. That's not an issue in a business setting. And then the safety and fire protection, security, all those kind of things, those are all going to be deductible as well. And anything related to HVAC will be an expense item. So that takes all that controversy out, particularly if you got a $100,000 HVAC repair. You really hate to have to spread that over time. So it's nice to be able to deduct those things along the way. So you can see there's a lot of simplification, but there's a lot of changes to get there along the way. When we lose the exemptions, we say, why did they do that to us? Well, it was partly a tax incentive. We had to give you some things and take some things away. But I hear behind the scenes, the IRS has more trouble managing dependents with some families than you can imagine, trying to say who gets which spouse, which palimony relationship you had, all of that aggravation. So they've eliminated it. They no longer have to keep up with dependents at all. So that's a simplification on the administration side. So that's probably a good thing. The other thing is having a higher standard deduction makes the IRS's process simpler as well. So from an administrative point of view, we've got tax simplification, even though they may be a little painful to get there along the way in terms of application in the tax law. All right, now for the long-awaited drum roll, please, QBI. This is a exceedingly complex piece of legislation. It's, I don't know, probably 200 pages of the tax law when you look at all these different things that go along the way. And we still don't have all the definitions, and I'll point those out as we get into this. So we will be evolving along the way. A lot of it's going to be decided in court, because when you talk about definitions of the SSTB, which I'll get into definition of that, when you get into the specific definition of that, there's going to be a lot of subtleties, whether you're qualified or not qualified in that provision. So we'll have to talk about those things. So the pass-through entities have a new odd path to their taxable income. This is Section 199A. If you recall, we had Section 199 for about 10 years, the domestic production activity deduction. That was a 9% deduction that construction and manufacturing was able to take strictly as a gift. It was that much of your income was not taxed. That was eliminated at the end of 17, and now we have a 20% deduction for most industries. So the construction industry is protected. They're one of those who will get the 20%. So that will be beneficial in that regard. But you will no longer have the 199 DPAD that we had before. Most non-passive income, and this includes rental income, will be considered qualified business income, QBI. And I'll use 199A and QBI, QBID interchangeably throughout this because they're essentially the same thing. So first you determine the taxable income from the pass-through entity and then take 20% of that amount and deduct it. So if you have $100,000 net income, only 80% of it will be taxable. It's not quite that simple because there's a lot of caveats and limitations, but that's fundamentally what you've got. It's not taken off the business K-1 that you get from the pass-through. It's taken on the 1040 in a special place. So it's a new line they have. Specified professional service businesses have a phase out of this amount, and we'll get into the details of that. But they deemed that certain professions were not entitled to this, and this includes accountants and lawyers and other professionals, investment managers, different people like that. So that will be important to keep up with along the way for those industries. High-income business QBID is limited based on wages and fixed assets, and we'll talk about the detail of that too. So if you don't have any wages and have a high-income pass-through, you may find yourself clipped there. If you don't have wages but do have a lot of tangible property, then you may be able to get under that. And we'll go into all these details. So what does QBI include? Qualified business income includes the income of a taxpayer, including a trust or estate, but not a C corporation, a sole proprietor, an S corporation, and or partnership that has pass-through income. So that's virtually everything except a C corporation being the one that pays its own taxes, all the big boys out there. From the conduct of a qualified trade or business in the United States, including rental income. Now that was kind of a wild thing that showed up. We said, rental income's never qualified for any of these breaks. Well, suddenly it does. So somebody got to somebody up there and said, let's put this in there, and it got passed through. Qualified real estate investment trusts, REITs, are included, as well as public partnerships and dividends from the REITs and qualified public partnerships. Those are pass-through income. Well, those have always been off the books because they're treated as publicly traded activities. So why would I get a break on those kind of pass-throughs? Well, it's going to be important to keep up with those now. So we'll find some folks moving in those directions because they get the extra 20% reduction. There will be extra provisions on those to show they have the qualifying wages and or equipment, because you're not going to know that because you don't see their financial statements. 199A deduction is a 20% reduction over overall qualified business income. It's that simple, except for all the extraneous baggage that we're going to talk about. It's allowed to itemizers and non-itemizers. It's not a Schedule A item. It's got its own separate line on the 1040. QBID does not apply for purposes of the 3.8% net investment tax. That's the Medicare surtax that we have had on the pass-through income, so you don't get the deduction from that. So you'll still have to pay the extra 3.8 on the investment income, but you don't have to pay the income tax. Most of the time, investment income is excluded from the QBI, so it really will not hurt us too bad. The QBID is available to those taxpayers who itemize and those who don't. Well, I've got that in standard deduction. The net operating loss does not affect the QBID, so you don't have to worry about that reduction in your income affecting your qualified business income. The QBID does not reduce your self-employment tax. So if you've got a Schedule C or a partnership that you pass through and have to pay self-employment tax on that $100,000, you'll get the 20% reduction in the income, but you will not get the reduction in the self-employment tax. You'll still have to pay it on the full 100, not on the 80 after the QBID. QBID is the same for regular tax and AMT, so it doesn't have any impact on that. But as we saw earlier, the threshold for the alternative minimum tax is much higher, so very few people will actually fall into that anyway. Okay, here's where the first caveat gets into play. For all qualified taxpayers whose taxable income does not exceed $315,000 for married filing joint, or $157,500 for everybody else, in tax years after 17 and before January 1st, 2026, if you believe Congress will keep their mitts off all this between now and then, an individual may deduct 20%, and I'm not saying this over and over again, but it's complicated and the redundancy helps us, 20% of qualified business income for partnerships, S corporation, and sole proprietorship. All of that pass-through income will qualify if you don't have any other landmines along the way. So basic example, $100,000 of QBI income, you get a $20,000 deduction. It's that simple. All right, example one, Sam owns an S corporation, makes $300,000 before his salary. He has a $100,000 salary, so his net income is $200,000. He gets a 20% deduction off of the $200,000. So you'd say, well, why wouldn't he just leave it at $300,000, not take the salary? Well, that's where the wage test comes in. We'll see that in a minute. If you don't have any wages, then you don't get the benefit. So example two, Samantha is a partner who receives a guaranteed payment from a partnership. Her share of partnership profits are equal to $200,000, and she receives $100,000 of guaranteed payment. That's the equivalent of a salary coming out of a partnership. The QBID would be 20% of the $200,000 or $40,000. So you don't have to worry about the salary deduction there because it's qualified based on the whole K-1. So limitation number one, the ratio of income above the threshold amount, which is the rule number one, general rule part one in the law, applies to any trade or business with a special rule for specified service trade or business, STBs, that restrict other limitations. So if your income is above the 315 to 415 range of the phase out, and half of that for individuals, that's the first rule is the income limitation. There's going to be industries that affects and industries that does not affect. So another example based on that, a taxpayer, a single woman, has $150,000 of qualified business income from a sole proprietorship selling T-shirts and pays no wages. With income of $150,000 from that activity and taxable income of $175,000, which is above the $157,500 phase out for a single person, the QBID must be reduced. So how do you get there? $175,000 is her total income, $157,500 is the threshold. You take the difference as $17,500. Then you divide that by $50,000, which is the range between the high and low of the phase out, and determine that 35%, she's got 35% of her income is above that threshold. So 35% is the number that we have to phase out. So the percentage by which otherwise available QBID must be reduced, in this case, allowable QBID is 65% of $30,000 or $19,500. So we're allowed to take 65% of that amount, and that's the QBID deduction. She's in that window between the phase-out numbers, high and low, and we take the ratio of that $50,000 range, and that's how we determine what the deduction is for somebody in that area. Thank goodness we have software to figure this stuff out. We'd have to double your accounting fee to do this otherwise. That's the only reason we get some of this law, is we now have the ability to calculate stuff with software. Limitation number 2, wage limitation. We talked about the fact if you don't have wages in a pass-through entity, then you may not qualify for this. So it applies to any trade or business except an SSTB, so a specialized service trade or business. So the wage limit at or below 157.5 single, 315 joint, you don't have to have the W-2 amount. If you're above those thresholds, that's where the phase-out starts. Then you have to see whether you've got W-2 wages or depreciable property. So we'll talk about the wages first. The only limitation in this circumstance is the taxable income limitation, which applies when the taxable income is less than QBID. This is not adjusted gross income, which is the last number on the front page of the tax return, or at least it used to be, because all of the forms are different, and we'll talk about that at the end. You'll not recognize the 1040 or the schedules 1, 2, 3, 4, 5, 6. We haven't had those before, right? Plus the schedule A and B are different. So we're talking about the phase out now when you're at above 157.5 for its individual, 315 for a joint. You don't have to worry about it if you're below that threshold about the wages. If you're above that threshold, you have to have wages. Or you have to have qualified property. And we'll go through some examples on this when we get there. Qualified property is defined as the unadjusted basis immediately after acquisition of tangible personal property held by and available for use in the qualified trade or business at the close of the tax year, used at any point during the tax year in the production of QBI, and if the depreciable period has not ended before the close of the tax year. Somebody want to volunteer what that means? No hands. I don't understand. What that means is if you don't have wages or don't have sufficient wages to qualify as a reasonable salary in order to qualify above the 315 or the 157.5 thresholds, you can take 2.5% of your property on your balance sheet. Okay, now we've got a little caveat here, because remember we talked before you can deduct up to $2,500 of your property. Well, if all you have is desks and chairs and computers, you've expensed all that. You don't have any fixed assets that we can use to calculate this qualified property. So it's what you put on the balance sheet and depreciate is what we qualify, and is based on the original purchase price. So if you have bought equipment and you still have it on the books and it's still depreciable within the depreciable life, which is where we're talking about this depreciable period is not yet ended. If it's 5-year property, you can use it for 5 years. If it's 10-year property, you can use it 10 years. You take 2.5% of those assets that are still being depreciated to determine whether you have any base to qualify yourself for the QBID. This only affects those above those minimum levels, 157.5 and 315. So is that a little bit clearer? I know it's still muddy, but that's the alternative test if you don't have sufficient wages. The depreciable period means the latter of the date that is 10 years after the property was in service or the last full year of the property's recovery period under Internal Revenue Section 168. So if it's a 5-year property, they're going to give you 10 years if you still have it 10 years. But if it's a 15-year property, then it's only going to stop, it's going to stop it, it goes to 15. So it's 10 years on everything except those that are longer than 10, and you can go for the longer period in that case. They will still qualify. So that's another calculation we have to do. What is the tangible assets that we have got on the balance sheet? Multiply that times 2.5%. So we may be wanting to clean up your balance sheets a little bit to make sure this is all legit. The W-2 wage limit is integrated with the unadjusted basis of assets. So you can use both of those. If one doesn't get you there, the other one can pick up the gap. QBID, Qualified Business Income Deduction, qualifies when the QBI is over the taxable income limit, 157.5, 315, and is limited to greater of either 50% of the allocable wage share of the W-2 wages, meaning if you own 50% of the business, 25% of the business, that's your share of the wages that you'll get on your K-1. You use 50% of that number as your test, or 25% of the allocable share of wages plus 2.5% of the unadjusted basis of depreciable property. So you'll be able to use 25% wages and 25% of the unadjusted basis of the depreciable property. So why would this matter? Well, let's suppose that you're an independent contractor and you have an S corporation and you're driving a truck and you're getting paid, say net income of $50,000. Well, that wouldn't matter because we're under that, but just for simplicity, let's say $50,000 net income from that business. He's got a truck, he's depreciating it, he's going to have something there, but he may choose not to take a salary. So we can't use the wage limit, so we can now use 25% of or 2.5% of that amount, and that can be 25% of the amount that qualifies to give him a little bit of QBID. So there's a big interplay of all these different things. Thank goodness for computers again, that we can do that. But you can get the fundamentals now that you either use all wages, 50% of wages, or you can use 25% on the wage side and 25% on the depreciable property side. If you have no wages, then you're just going to get half because you only have the depreciable property. So a little bit clearer maybe? You can kind of see through the fog? I know it's nonsense, but it is what it is. The unadjustable basis is the depreciation deductions relative to the property not taken into account with respect to 2.5% limitation. Taking a bonus in Section 179 will have no impact on this limitation because you have in fact put that on your balance sheet. It's a depreciable asset, and even though we fully depreciated it either through bonus or 179, you're still getting the full deduction. The full allowance, because you're using the original cost, you're not using the net. Now, one other thing, I don't know that we mentioned this before in going through, but this can come into play right here. In the past, when we've had trade-ins of property, you trade in a truck or heavy equipment or something like that, in the past, we've taken the undepreciated portion of that and rolled it into the next, the like-kind exchange, into the next equipment. So if you had $1,000 left on some asset and it's being traded in for something else, you take the $1,000 and add it to the cash paid of the new item, and that's your new basis. We no longer have trade-ins, no longer like-kind exchanges on the tax basis for your balance sheet. So we'll have to now have a gain or loss on the trade-in versus the cost or the net depreciable basis. So if you got a $5,000 trade-in on a $1,000 net basis after depreciation, you've got a $4,000 gain on the trade-in of that old vehicle, and then you have to take depreciation on the new one in full. In most cases, that's not a problem because you're going to take 179 or bonus on the new item, so you've got a full deduction and a gain, and they net out. So you're going to have about the same answer, but we have to go through that exercise now. I'm not sure what lobby fell down on that one, but anyhow, it's a little caveat we've got to do. But that's an aside from here. It doesn't matter if you take depreciation on an accelerated basis over 5 years or 8 years or whatever it is, or if you're going to depreciate it under 179 and the full deduction, or you're going to take it as the bonus depreciation. We still take the original value of the unadjusted basis before depreciation in calculating these QBID deduction limitations. Now, what is a wage? That was one we had to get some definition because the law didn't specify. And in August, I think it was, they came out with some rules what wages are considered. Because as you know, there's all these boxes and all the different numbers, and you got box 14, box 12 that have all these limitations and phase outs, all those different things. They came up with a definition of what a wage is. It includes taxable wages and deferred compensation with an add back for employees' elective deferrals. That would be a 401k, for example. So your gross wage is going to be the gross wage before having the deduction for the 401k. Allocable W-2 wages for a shareholder are, like all other items of an S corporation, allocated pro rata based on a per share per day basis. So if you own 25% of an S corporation, you're going to have disclosure to you of 25% of the salary. We had that on the on the DPAD before. That was shown on the back schedule of the K-1. So we always had that information, but this will also have to be a disclosure that the preparer of the return will have to give to you as a shareholder or partner. Wages paid to an employee include any elective deferrals like a 401k, which I mentioned that, or any other deferred compensation. So gross wages will be gross wages, and that's how we'll deal with that. From a partnership, the wages are also going to be allocated through a partnership just like they are with the S corporation. You'll get your allocable share based on your ownership. 20% partner may specifically be allocated 80% of any depreciation, and 30% of Schedule K-1 ordinary income under the partnership agreement. A lot of partnership agreements, as opposed to an S corporation, everybody's got to be uniform in terms of their percentage. In a partnership agreement, you can pick and choose income and deduction items in your agreement. So I'm going to take all the rental income and you're going to take all the operating income. I'm going to take all the depreciation, you take all the interest. We can divide those things up in a partnership. You can't do that in an S corporation. So the 20% partner will still be able to take all those pieces and parts. So we have the tax planning opportunity. This works very well with generational partnerships where the elder wants to get certain things and the younger is maybe in a lower tax bracket, so you give them more income and you take more deductions. So the 20% is going to be based on your percentage of ownership in the pass-through of the QBID items, but you will be able to manipulate your income based on your partnership agreement. Because the partner is allocated 30% of the partnership's line one income, that's the gross income, the partner is only allocated 30% of the W-2 wages. So no matter what you do with all this other stuff, it's what percentage of capital or your profit and loss allocation is going to be, is the amount of wages that would be passed through. Wages allocated from an S corporation, it is what it is, because you are fixed. Everybody's got to be the same or you can lose your S election. So all the distributions, all the allocation of income, interest, deduction, depreciation, all has to be done based on your ownership share. Limitation number 3, specified service trade or business limitation. I've danced around this and now we're going to drive straight through it. It applies only to a trade or business identified in the statute as not qualifying for the general rule, meaning that everybody else gets the goodies of the 20% deduction except those in this category. So the disqualification for SSTB is those that are in these specific industries, if they're above the 315 or the 157.5 income threshold, and this is taxable income, then they have to deal with a second calculation to see whether they are going to be qualified or not. And they are, and it's in your handout if you can't read this. Specified service trade or business means any trade or business involving the performance of a service in the fields of health, doctors, nurses, etc., law, lawyers, paralegals, accounting. Anybody that does tax preparation for a fee is considered an accountant. I don't care if you get $150,000 working a day job. If you make $2,000 on the weekend doing tax preparation, you're stuck with this on this little piece of your income. Actuarial science, performing arts. So now you got all the actors out there, all the singers. They're all going to get clipped on this. Consulting. That's going to be the tricky one. What is a consultant? We're looking for more definitions with that. But consultants generally are anybody that provides advice only. So if you come in and you need, should I buy or sell this property? And you do a calculation, you're a consultant. But if it's a real estate commission, you're not a consultant. That's part of the service that you're doing. Athletes, this is a new one too. If you are incorporated as an athlete, then you're going to get stung on that. Now, usually you're a salaried person, but you can imagine most golfers are independent contractors. Most tennis players are independent contractors. So they're going to get clipped on this because they are a specified service trade or business. Financial services. This one took some extra definition. Anybody that's buying or selling securities, and there's a whole long list. I think there's 9 different specifics of defining what the financial services are. They are going to be limited in this. However, an insurance agent is not. Again, I don't know how the lobbyists work through this, but if you're doing a variable annuity in a life insurance contract, you're selling an insurance contract and you're getting a commission. Not any different than the guy that's over here selling mutual funds, doing the same kind of investing, but he gets clipped on his commission or management fee while the insurance agent does not. And then brokerage services, including investing, investment management, trading, dealing in securities, partnership interests, commodities, or any other trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. So that covers a broad range of people that are in the security business. And there's one other one in here that I didn't list, but there's any other business that has personal services, the primary source of income. I thought that was going to include people like fortune tellers. Not that anybody made $300,000, maybe you could, but it doesn't. It's anybody that is specifically earning money as a consultant, doing advice, doing things like that. It's not just anybody out there doing a service. You hire somebody to rake your yard, that sort of thing. They will not be included in that. Okay, back to the 157.5, 315 limit. For the SSTB businesses, starting at these two thresholds, individual and joint, you're going to have to limit your income, limit your qualified business income deduction based on these rules. So the example down here is you have taxpayer, single taxpayer with $157,000 from the accounting practice, and total taxable income is $175,000. So again, we're going to be clipped, as we did in the previous example, $157,500. 175 minus 157.5 is 17.5 divided by the 50 phase-out threshold, 35%. So it's the same example as before. So whether you don't have wages in your business, so you don't have pass-through, or whether you're a person with a SSTB source of income, they both get phased out the same way. Same facts, except one in case it's a regular business but had no wages. In this case, they may have wages, but they're in a specialized service trader business. Example 4, Dave is an unmarried individual and has a CPA practice where he earns $100,000 annually. Assuming Dave's taxable income is under $157,500, he is entitled to use the entire amount. Because he's below the $157,500 threshold, he doesn't have to worry about the fact that he's an SSTB. Example 5, Doris is an MD with a QBI of $500,000. She files an income tax return jointly with her spouse. With his losses, their taxable income is only $310,000. There may be some divorce in the future in this one, I don't know. But anyway, even though Doris has a QBI for medical practice, which is an SSTB, she's entitled to the full 199A deduction because their joint income is not greater than $315,000. So now you see the interplay with all of the other sources of income. You may be over the threshold in your specialized service business, but you may have an offsetting deduction from some other source. It could be a rental loss, it could be a business loss, whatever it may be. So you have to put all that together. So in this case, she would get the full 20% of the taxable income of $310,000. So now we look at the interplay of the phase-out in the specified service trader business. When the income of a specified service trader business, SSTB, exceeds the threshold amount and the phase-out ratio is 0, it is possible to qualify for the QBID. However, the calculation is more complex than a simple percentage of wages and property. The ratio would limit the QBID and is applied to the potential wage and property amounts to determine the QBI to which the 20% allowable QBID is applied. So if you don't have enough wages, or you don't have enough equipment, or you're over the threshold and you're in that phase-out zone, it can be a very complex calculation, as you could see, because you may not have enough wages to get there, even though you're under the limit for wages. But you may, SSTB, or you have more SSTB and not enough of the other. So you have to look at all the interplay of all these things. Again, thank you for having computers. Limitation number 4, capital gains. Taxpayer cannot deduct more than 20% of his or her taxable income after subtracting net capital gains, but before deducting the 199A. Capital gain income has to be subtracted to determine how much the limitation is for the 20%. Because remember, you're taking 20% of your taxable income. So let's assume the taxpayer would receive $40,000 in 199A qualified business income. I'm sorry, $40,000 on a $200,000, 20% of $200,000 from the pass-through entity. If due to deductions, the taxpayer's taxable income is only $160,000 instead of the $200,000, and that amount includes $60,000 of net capital gain, the taxpayer's QBID is limited 20% of $160,000 total, less the $60,000 capital. It's only $100,000. So you get 20% of 100. You don't get 20% of 160. So we have to take out the capital gain portion of the income to determine the qualified business income limitation. Example, the taxpayer has $2 million of QBI from the sole proprietorship, has no depreciable property, pays an assistant $100,000, potentially entitled to QBID of $400,000. You see, we keep making these problems more complex because this is reality. Reducing income by 37% of $400,000 or $148,000. However, the individual's taxable income far exceeds the $157,500 threshold, so the QBID is 50% of the $100,000 or 50. So you're going to be limited because the wages are too small, even though there's no restrictions otherwise. So she would get 37, well, whoever, it's 37% of $50,000 or 18.5. That's the only amount they're going to get. So that's unfortunate, but that's how the rules are. You've got to look at all of the factors. So it might pay to pay more salaries in order to get a bigger deduction. Example 8, taxpayer is an S corporation shareholder, has $1 million of qualified business income, and is potentially entitled to a QBID of $200,000, 20% of $1 million. But allocated W-2 wages are $300,000, and the corporation has no depreciable property. So she can only deduct $150,000, which is 50% of the 300 or 150. Potentially reducing income by 37% times 150 or 55.5. So because there's not enough wages, there's not going to be the ability to take it all. The wages are 300, you're limited to 50% of wages, so you have to take the 150,000 as the base of the limitation. So that's all we're going to be allowed is 37% of the 150,000. Example 9, the current tax year qualified business has $100,000 of ordinary income from inventory sales and makes an expenditure of $25,000 that is required to be capitalized and amortized over 5 years under applicable tax rules. QBI is $100,000 minus the $5,000, which is 1/5 of the 5 years of $25,000. So that leaves you only $95,000. QBI is reduced only by the amount of deductible in determining the taxable income for the year. So what do we do about all this? You need to be prepared. You need to think it through. You need to look at all the caveats that are going on in a year and maybe plan some things. Well, I don't have enough QBI equipment to make this work. I need to have more salaries. I need to buy a piece of equipment. I need to put something on the books in order to make myself qualify. Or maybe I don't want to do it this year because I'm going to have more income next year and that deduction's worth more to me next year to get me below that phase-out threshold. All these factors play into the game. I read an article yesterday, very interesting. A guy was talking about his retirement planning. He said, well, if I take a deduction to put it into my retirement plan, I'm reducing my taxable income, which is going to reduce the amount of the 20% that I'm reducing my income that I pay tax on. Is it better for me to take a $20% reduction in my higher income, or take the lower QBID calculation against a lower income after taking the retirement plan? Obviously, there's some algebra involved in that calculation, but it may be worth thinking about. Is it better to have more taxable income and get a higher business QBID deduction, or take the business deduction for the retirement contribution and pay a lower tax because of that, thereby limiting the QBID deduction? So I know that's a whole lot in a short period of time, but what questions do you have about this? Everybody has a glazed eye in their face, right? What about anything else that we might have covered that you may have questions about? There's a lot of things that are the same. Capital gain rates are still 15%, 20%, or below a certain threshold, 0. So capital gain hasn't changed. There's still a $3,000 limitation on capital losses. Itemized deductions are a train wreck, so they're all going to be different. The actual Schedule A is shorter. So I've either totally covered it or totally confused you. I'm not sure which. You think? You think you need a CPA? That's a good news. You're going to push us over that 315 limit and have to pay taxes. Yeah, one thing I learned a long time ago in tax planning, I don't care how much your income is, it's never 100% tax, so it may be worth earning an extra dollar. Now, if you live in a state that has income tax, it's really going to be a mess, because most of the states are not adopting this deduction. Most of the states have not adopted bonus depreciation. So you've got to look at the interplay between the income tax in Florida versus the income tax in other states. There's only 7 states that don't have an income tax. And even my own son, who lives in Tennessee, has got a little business, and they have an income tax on S corporations, income tax on LLCs. So it's not like Florida. We're blessed to have S corporations pass through without any income. All right, well, I thank all of you for being here, your participation, and trying not to be too confused. If you've got questions, certainly feel free to get with us. We just want an endless supply of milk. We don't want to have to feed it. This is the guy trying to get stuff from the government, right? So we do thank you for being here. There's a contact information for the three of us. We're all prepared to at least look up the answer if we don't have it yet. Our software folks are working diligently to get this done, so we'll have some good software to calculate all these things. We do have a tool to be doing some of the projections already because it is a totally different line and a totally different place to calculate it all differently. And there's a tips for selecting an accountant, which you've already done. I know it's got one of the best in the world. But we appreciate our guest here looking out for the public, taking care of their education as well, and look forward to your having a good Christmas and seeing you in a few months to do your tax work.